Folks, the saying, be careful what you wish for, has a reason, because even though we wished for a 75 basis point hike, take a look at what the last year of the S&P 500 looks like visualized. And boy, oh boy, I'll tell you, that looks like a pretty damn bloody bitchin' thumbnail, because it's just so ugly. Ooh, but it's not just looking ugly, it's look at some of these underlyings here. This particular chart right here shows market breadth. And I don't mean meat breadth, I mean market breadth. And what this is a measure of the number of companies trading above their 50-day moving average. And if you guessed that there's probably no company trading above their 50-day moving average, you're pretty much right. Because take a look at this blue line right here. This is where we get the percent of members trading above their 50-day moving average. Now I'm going to take this beautiful little green circle here, and what we're going to do is point out the end of 2018 right here. We hit the zero line basically. You can see that. Well, actually, it's a teeny little bit above the zero line. Like there's zero and there's the yellow line, right? And then over here you get the pandemic, and then of course you have right now hiding back here. And what's fascinating is every time we hit that yellow line, look at what the S&P 500 did. We hit bottom, and a question mark, because the question mark is obviously where we are now. Now, I don't want to be the person to say that, oh, but hey, look, the QQQ is green to start the day off. We're up 1.1%. Oh my gosh, maybe if we go up 2%, we'll get back remotely close. No, we won't. To 280. Yeah, exactly. We won't, because take a look at this. You go to the day chart, and it's just a disaster. I mean, the Fibonacci's got absolutely reamed. Here are Fibonacci's from the top to 0%. We quadruple bounced the Fibonacci 0. Then we're like, yeah, no thanks. Let's go to another low. And now we bypass even that low. It is absolutely ridiculous what's happening in the market. And it's no surprise that when we just straight up measure declining stocks versus gaining stocks, we get a chart that looks a lot like this. This is called the tick chart. And the crazy thing about this is this chart goes all the way back to the late basically late 80s and early 90s. And as you can see here, this is your zero line right here. So red days are generally below that, depending on the market cap of these companies. But anyway, more losers would be below the line, right? And take a look at the harshest days ever. Look at that. There you go. We have now just hit one of the harshest days ever. And there have only been 2 of such in the last 30 years. Yeah, it's a pretty painful market. By some accounts, the market is collapsing 3 times as fast as it did in the dot-com bubble, which, of course, when I tweeted that out, follow me there, at RealMeatKevin on Twitter, many of you are like, that means maybe it'll recover 3 times as fast, which I can't blame you for thinking that, because after all, we've got some good news. I'm back from my vacation. We've still got a week left before the prices on the courses on building your wealth in stocks and real estate go up again. Use that 50% off coupon code before the prices move again. Link down below. Now, the thing that we got to know is Powell's yapping in the Senate today. We've got Bullard yapping today, and 75 basis points are going to hit earnings. But they're doing this to try to prove credibility. Now, these generally lead to words that we don't want to hear. The last Fed chairperson to feel that they had to prove credibility was Paul Volcker, who raised interest rates nearly to 20% to outpace where inflation had entrenched itself for a period of 6 years. Fortunately, we're just facing about 1 year of inflation now, but Paul Volcker said this morning, sorry, you can see where my head is. Mr. Bullard said this morning that Volcker had to earn his credibility. And then he sort of implied that today we're somewhat credible. Maybe we have some credibility left. Now, Powell is in the Senate today reiterating his commitment to 2% inflation. And we know that Vladimir Putin had a speech this morning, which is probably their afternoon, where he said that the war in Ukraine will only end once Putin accomplishes his mission, which is protecting the Donbas region, defending it, and completing all of the objectives of his special military operation. Now, Putin, when asked about the West suggesting that he is causing inflation, essentially laughed and kind of said, yeah, right, y'all just straight up print money after your pandemic, and then you go out and shop. Now you're blaming me for inflation? You can't kind of blame him for the slapback there. But anyway, The S&P 500 now implies an 85% chance of recession. That is, recession being priced in could potentially be a good thing, but doesn't necessarily align quite yet with history. Because if we look at this historical chart here, what do we know? We know that if we go back to 1929 and we overlay median recessions, we know that if we end up having a recession, we still have two bottoms ahead of us, which is not great because we're at a pretty painful place right now. Honestly, it feels a whole lot like we're on the Titanic, and some of us are still hodling on while the Titanic is flipping up. Which is, by the way, a video that I'll link down below, which I made back in January, and I got a lot of hate for suggesting that maybe things would collapse, which one of the things that I can't help myself for bringing up is in that video, I suggested the collapse of stablecoins. And guess what? So far, we had the massive Terra Luna collapse, and now people are looking at other stablecoins going, oh man, what's next? Anyway, whew. Now, by some regards, people, especially retail, have still not yet capitulated. In fact, if you take a look at this chart right here, what do we see? We see the triple QQQ, or the triple NASDAQ. Now, even though the triple NASDAQ has been going down, this line is going up. It's going up because there are more shares outstanding, which means more people keep throwing money into the triple NASDAQ despite the fact that it's been losing money like crazy. This right here is a sign that retail, generally retail, continues to be bullish on America, that retail is not capitulating, and that there's still a massive appetite for speculative investments. Not to mention the fact that if you hop in over here, what do you have here? You have the fund flows for RK, and they have been positive all frickin' year long. Above the green line positive, below the green line negative. Cathie Wood is somehow still substantially attracting money, which is suggesting that full retail capitulation is not even close yet. People even say the bond market has not had its full capitulation yet, though I will tell you the bond market's moves yesterday were kind of scary. Yesterday, the 10-year Treasury yield, which dramatically affects mortgage rates and is one of the things that I'm really paying attention to because I think it's going to be a huge leading indicator for how bad that real estate kind of correction or crash could end up being. How many opportunities I'm going to be able to buy in real estate. Really looking forward to being able to buy in real estate, especially since I sold about 22 properties at the beginning of the year, closing a couple of the remaining ones now. But the 10-year Treasury yesterday, which is almost directly correlated with a 30-year mortgage, shot all the way up to 3.45%, which would have easily pushed mortgage rates up to about 6.3 to 6.5%. Now, that 10-year Treasury in after hours plummeted back down to where it is now, 3.24%. So why did we have a 20 basis point move there? Well, potentially because some investors are now saying that TINA is dead. Remember, TINA is, there is no alternative to stocks. And if TINA is dead, that means, no, wrong. If I can get 3.2% on a 10-year Treasury yield, I'll take that 3.2% annually for 10 years over bothering with what could be a gloomy or, dare I say, frugal decade in stocks. In fact, that's why markets are so frustrated right now, and because we continually expect that earnings forecasts are going to get revised down, and that we're potentially going to see an earnings recession that lasts years. And that means years of bad earnings or declining earnings, that we ended up having a stimulus precipice, and then it's down from there, and it'll take a while to actually hit bottom and come back out. The Philly Fed, not too happy either. Current conditions contracted, and expectations for the next 6 months are consistent with previous recessions. Ray Dalio is shorting European stocks with a $5.7 billion bet, and folks, maybe some good news. You can get $1,000 totally for free. Well, up to $1,000 totally for free by going to metkevin.com/public. Sign up for Public, deposit any amount of money, and you will get no payment for order flow, a social platform in which you can buy stocks and ETFs. And folks, you will absolutely love how easy the platform is to use. Check them out by going to metkevin.com/public. And when you deposit any amount of money, you'll get up to $1,000 in totally free stock. But we do actually have other good news as well. And that is the likes of JP Morgan. JP Morgan released their May delinquency rates for credit cards and found that they're down to 0.67% from 0.7% in April and down from 0.69% in May of 2021. That means year over year we've improved, and month over month we've actually improved in delinquency rates. Now, JP Morgan did see an increase in the rate of charge-offs, sitting at about 1.725%, which is a slight tick higher. It's actually about 50 basis points higher than where we were in April, but it's about roughly in line with where we were last year, and it's a good amount, about another 50 basis points lower than where we were in February of 2022, right before the pandemic. So in other words, the inflection here to notice is we really haven't actually seen an increase in delinquency rates yet. We're pretty damn consistent. And even though we're seeing substantial distress in the bond market, and we've seen bond distress ratios go from 2.4% to nearly double to 4.3%, which potentially suggests we could see more defaults like what happened with Revlon's bankruptcy filing, which finally came out. But if we look at the last 5 years, the average distress ratio in the bond market was actually 8%. We're only at 4.3% now, and that's well below the 30% distress ratio we usually see going into recessions. And many credit firms, like the Standard & Poor's and Finch and the credit rating agencies, these agencies are still upgrading companies, something that they generally don't do right before a recession. On top of that, we're potentially starting to see demand destruction, which Cathie Wood has always alluded to, in the amount of gas and oil that we use. Take a look at gas product supplied and then, in other words, used. In other words, how much gasoline is the United States actually demanding and using? We are sitting nearly 6% below the gas usage we used to have. We were here, we are now here. Now again, it makes sense. Prices are more expensive, but it's an indicator that we are starting to see demand destruction. Why, if we go back to years like 2018 and 19, we're actually using less gas? Well, again, yes, price, but when price goes up, demand should go down. That's the point. That's demand destruction. It just is a good sign, though, in some sense, that we are actually seeing a turn down in gas demand because it does end up putting less pressure on gas prices to continue going up. If we were still using the same amount of gas prices could be even higher. Seems crazy. But anyway, take a look at some other things that are at least some signs of hope. Here's a chart of air freight pricing. And you can see air freight pricing really peaked around the end of the year, and we've really come down since then, which is great. This is a chart of fertilizer pricing, which we saw some real drama after the Delta variant, and obviously some serious drama when the war in Ukraine began. But take a look at where we sit now. We really sit at roughly the beginning of both of these crises, which is not bad. That kind of looks like a sad face. Take a look at lumber. Here, we'll switch to a little red line to draw on. Lumber prices previous to the pandemic have generally sat somewhere around $400. And take a look at the chart that we have now. Right now, the chart sits roughly above the $500 level, but it is substantially below the peak that we had also during the Delta era and during this latest commodity boom following the war in Ukraine. Take a look at this. This here is the many used vehicle index, where we has seen a nice downtrend here in used vehicle prices. Though unfortunately, and we saw this in the last CPI report, we did get a little bit of an uptick here as well. We've been doing pretty well in at least getting it to push down, although we have played this song before. So hopefully we can just get this to consistently trend down rather than just give us these little fake outs here. So we do have at least some signs of good news, but there's some big things that we should be thinking about going forward. And yes, I mean big things in addition to you finally joining the amazing programs on building your wealth. We're going to have an amazing live stream today, and we've got such an amazing tool coming out for course members in the next 2 weeks for a ton of new lectures. It's going to be really, really awesome with a new style of a studio, so we're super excited about that. But what do we want to think about going forward? Well, number one, in my opinion, and I don't want to just rehash old things, I mean, you know, the obvious ones, but number one, I would personally at this point limit my exposure to stable coins. I personally don't believe that a 7 to 10% yield is worth the risk of a Terra Luna style collapse. In a recession or in extended depression or era of crypto liquidity and liquidations volatility, I would not want to be exposed to an asset like stablecoins. Now, if I'm locked in, all right, well, I guess I'm locked in, but if I could withdraw, it'd probably be something I would highly consider because I think my cash actually has more value than that potential 7 to 10% that I'm going to get over the next year just by sitting, waiting for a new opportunity. Remember, if asset values go down, your cash actually experiences deflation, not inflation. You really only experience inflation on the cash that you use to buy food and energy products like gas. Now, number two, I'm just recommending be careful with very high volatility plays. Buying puts and buying calls are very, very difficult in this kind of market because volatility is so high and you're going to get squeezed to crap, no matter if you're right on direction or not. Now, this does make for an interesting opportunity to sell calls or sell puts. Obviously, number three, the obligatory get out of debt as fast as you can and eliminate the potential for a rug pull. Takes a lot of stress away. Also, I do want to caution, number four, green days, in my opinion, are unlikely to last in this kind of market. So you really have to ask yourself, how much cash do you want? Well, that's up to you. Do you want to be 50% cash, 50% in the market? Do you want to be more like me, where I'm roughly 90% in the market, maybe 10% cash? Maybe that's somewhere between 80-20, somewhere around there, depending on how the real estate opportunities close. But for me, I see some beautiful opportunities, and I like taking advantage of those. And every time I make a different move, which we're going to be doing a whole lot of moves over the next 6 months once our market sort of evolves, and even on these dip days, you can see every single one of my buy or sell alerts based on what I'm doing with my portfolio, which is not necessarily a suggestion for you, or it's not at all. It's just what my portfolio is doing. And then you can interpret whatever you want to do yourself. You can get that in my Stocks and Psychology of Money program, linked down below. But folks, you've really got to ask yourself right now, how patient can you be? Do you feel comfortable getting into, for example, commodities or even companies like Occidental Petroleum, which what's interesting here is over the last month, they're down 16.33%. If anything, some folks are growing quite tempted to potentially even short oil companies because we don't expect oil to stay this expensive for this long or much longer. But what if it does? Who knows? All I know is everyone's getting hurt out there, and if you're not patient, you're gonna have some real potential issues. Some folks are even suggesting real estate or shorting real estate in the stock market. But you have to be careful because the stock market has already moved a lot of these real estate companies down 20 to 30%. What if the stock market rebounds, lifting these companies before a real estate market even slows down? It's tough to know with certainty, but there's one thing that I know, and it's patience is everything. So I hope to see you in the programs on Building Your Wealth linked down below. You get lifetime access to them. You get access to me in our course member live streams. And folks, we'll see you soon. Thanks so much. Bye.